Welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
In October last year, we analyzed a fast-growing Canadian business, Enterprise Group. That analysis included a 90-minute interview with Des O'Kell, the company's president. You can find it in our investment ideas on the Rock and Turner Substack. Since then, the company has made an exciting new acquisition which promises to accelerate its growth, so we've invited Des back for another chat.
The enterprise has been on quite a journey in recent years, with a series of big moves that have reshaped the business. Things really took off with the acquisition of Evolution Power a few years ago, which marked a major shift into supplying power generators, and the momentum hasn't slowed. This year's acquisition of FlexEnergy Canada is set to push growth even further. In this conversation, we'll dig into the company's evolving strategy, how they're thinking about capital allocation, the role of turbine technology, and plenty more. I'm joined today by Des O'Kell, the president of Enterprise Group. Welcome, Des.
Thanks for having me.
My pleasure. Great to speak to you again. So you've built what I'd call a horizontally integrated business with 4 complementary segments working together to offer a full stack of services. But out of those 4, Evolution Power seems to be the real engine of growth right now. Is that a fair way to view the business, or do you see all segments as equally critical?
No, James, that's accurate. Obviously, as the sector we're servicing, which is the energy sector, we've experienced some CapEx increases for the last few years, and that bodes well for our entire package of subsidiaries and so forth. I mean, ultimately, we are what we offer the clients, of course, is site infrastructure, and inside of the site infrastructure equipment offerings, of course, is mobile transportable power. And as you mentioned, our position, our leadership position in mobile power is right at the top. We're in a terrific position, and the very interesting things that are happening around our power division is that it has the opportunity to venture out into other industries other than just the energy sector and so forth. But I mean, I'm sure we'll get into the granulars over the course of this conversation.
Sure. You don't break out segment-specific numbers in your reports, but it seems clear that the synergy between these 4 segments creates a competitive edge for you. So do you view these divisions as inseparable parts of a larger whole, where the sum is worth more than the parts, or is there ever a case to be made for perhaps divesting some of the others to double down on Evolution?
I mean, we're not there yet. Obviously, the site infrastructure offering in the energy sector is more complete with the other equipment offerings. I mean, when we talk about site infrastructure, I kind of lean on, just for understanding's sake, there's 3 pillars to site infrastructure. Because these projects are in remote areas where there's no infrastructure, there's 3 pillars of equipment offering. These operations are 24/7 in remote areas, so they are going to need power systems to power that particular project site. So those are mobile systems that we have. We'll get into some of the leadership moves that we've done where we're right at the tip of the spear. But on top of that, we have a fleet of mobile office type structures or command centers, medic buildings. All of these are mobile structures that can be moved onto site for the length of the project, and of course carried off and moved to other locations. So those structures are very important in site infrastructure, as well as because of safety and the fact that in the areas that we're working in, which is northern Canada, for half the calendar there's more darkness than sunlight for half that calendar. So lighting is a big deal. Lighting is on 24/7. It needs to be powered and so forth. So those are the 3 pillars: mobile power, the office and mobile structures, as well as lighting. And of course, there's all sorts of ancillary combo equipment and other things that make up in between, all the nuances that are needed on site by the client. But that is what we call site infrastructure. Obviously, our power division, it's a little more agnostic. It can move around to the application of our power systems could be in multi-industry. Obviously now with our new acquisition of the FlexCanada operation, now we're not just mobile temporary power project to project style business. We are now we have the opportunity to of course place our turbine technology in what we call long-term or permanent installations. So as I said, we'll talk and flesh this out over the course of the conversation. But our power division is one that can start expanding to adjacent industries, of course, regionally, both in permanent installations as well as temporary power.
Right, that makes a lot of sense. So, assuming the full stack stays intact, how do you think about reinvestment across the group? Evolution might be generating the best returns today. So, how do you balance reinvestment across the other three segments of the group?
Well, it really is all about customer demand. So we are obviously in the Evolution Power division. Demand from the client over the past, call it 2.5, 3 years, has been robust. We've been adding new names. It's a new method of mobile power. So there's an adoption rate that isn't always the same with one company to the other. Some companies adopt the methods quickly. Some take much time. There's some logistics. If they want to use their own gas out in these remote areas, there's a little bit of logistics to make that gas available. Of course, that's when you can achieve, or the client can achieve, tremendous value because when we displace the incumbent, which is diesel fuel, they're paying a third party fuel distributor for that. So if they can eliminate the diesel fuel, displacing it completely from a project site and utilize their own fuel, I mean that expense here in Canada, diesel is $1.50, $1.60 a liter. Those are real costs when you're using thousands of liters a day of fuel. So these are things that we're providing with these new methods.
Okay. So let's move on and speak about the Evolution Power story and the kind of turbine strategy, if you like. When you first acquired Evolution, you tested the waters with the capstone generator units before shifting, I think, exclusively now to FlexEnergy solutions. What were the challenges with the capstone units that led to that pivot? And as I understand it, you still have 5 of those capstone units. Are they earmarked for special use cases, or are you planning to fully phase those out?
Well, obviously we own them, like other power systems in the fleet. We'll circle them out when needed. But I mean, you ask about the challenges. Um, the capstone unit is it definitely has challenges in the extreme cold. So, once you get to -15, -18, it has challenges. It has troubles. The other part of that is the fuel tolerance. It's very important, and that's why we've built the fleet around the flex turbine is purely fuel tolerance, because we are subject to field gas or solution gas, flare gas, or gas right out of the well. It hasn't had a chance to go for any upstream refining or what have you. Having fuel tolerance is very important if we're going to be using the fuel that's out in the field in remote areas. So again, the capstone had a tighter fuel tolerance, and it's plain and simple. When half the calendar we are dealing with very extreme conditions, it's very possible we can see -18 and well colder than that for a month at a time. So these conditions made it very simple for us to decide to build our fleet around the flex unit, because just in the second week of February, not long ago, in one of our areas, we were for 2 evenings in a row reached -52 degrees C.
Wow.
Our flex fleet that was operating, absolutely zero interruptions. It seems to enjoy operating in the cold, and like what more can I say? I mean, that kind of uptime reliability is exactly what the client is looking for. So enough said.
Yeah, I think that answers the question. So effectively, the flex units are far more versatile than the capstone units, so it makes more sense to be using those going forward. I think that probably sums up what we're saying, right?
Exactly. Mm-hmm.
Yeah, perfect. So my current understanding of your fleet, please correct me if I'm wrong here. I've been doing some kind of digging around. It wasn't easy to find the numbers, but you've got 5 of these capstone units, which are about 200 kilowatt units. You own 25 of the 333 kilowatt flex units. You've got another 10 on order to be delivered through this year. Plus, you're buying off-lease units. I'm not sure how many of those. You also had, at the end of last year, delivered 250 kilowatt flex units, 4 of those. And as a result of the FlexCanada acquisition, you've also acquired 17 of their units. Plus, you've got the 2 megawatt units coming online. I'm not sure how many of those are coming. But on the back of envelope calculations, by the end of 2025, it looks like you're probably roughly doubling Evolution's capacity to about 61 units compared to the 30 that you had at the end of 2024. So with this kind of scale up, plus the synergies of the acquisition and the added maintenance revenues that you're going to be seeing, should we expect to see a near doubling in top line revenue and improved margins?
Well, a doubling is going to be, that's pretty rocket fuel. I mean, like I said, there's an adoption rate that as we add the new names and get that available market in front of us, coming to these power methods. I mean, absolutely, it's achievable, but inside of 1 year, that might be a tall ask. So I'd like to temper that somewhat, James.
No, that's fair enough. Okay. But you're seeing quite strong demand anyway. So in terms of adoption, it should be relatively easy to deploy these additional units that you've managed to acquire
Well,
over
yeah,
the course of time.
yeah, and I mean we're at the as the I mean you look at we had a bit of a disappointing Q4. That was purely related to delays that were happening at a major LNG project. That LNG project, in fact, a news release came out, or a piece of news came out yesterday, that they're looking at first cargo in June. I know about 2 months ago, Petronas Canada, who is a partner in the LNG Canada facility, had said in a news release July. So anyway, it's happening June, July. I think 8 and 10 months ago we thought it was going to be Q1, and then there was the delay and so forth. So projects got moved and kicked down the calendar, and it basically created quite a low activity Q4 for us that was completely unexpected. We weren't aware of the delays. We're not privy to the comings and goings that were happening at the facility that was being constructed. So it was news to us, but those projects and so forth are now in front of us. So we, unlike last year, we had a very, very rocket-fueled front half of we had a Q1 and a Q2 that were excellent. Activity levels were, phenomenal. This year, it looks like the back half of the year is appearing to be where the big lift is going to happen. So again, we're at the beck and call of the client when they have a project go off. That's when the project goes off. If it gets delayed.
Yeah. That's interesting. I want to lean into that a little bit because, as you say, Q1 to 2024 was very strong. Your Q1 2025 numbers were also pretty good. They weren't quite the same as the 24, but given that 24 was extraordinary, the fact that you even came close was impressive. And now you're suggesting that the back end of 2025 is going to be even better than the front end of 2025, having started off strongly in 25. That sounds quite promising.
Yeah, we've got requests for RFPs, RFQs that are coming in for projects that look like they're going to be set off in June, July, and forward. Obviously you need those projects to kick off, but it looks like planning from the clients is happening at that kind of rate. So we expect to if we get half or 3/4 of that activity, it'll be a strong back half. So knock on wood, there's no more delays. I think we've seen evidence of certainly the LNG plant. They received a cargo of LNG on April 1st from Western Australia. That was brought in to inject into the whole train system there to cool everything down. They're able to get all their pressure tests of their vessels and piping done. And I was on these articles that I saw over the last couple of days, that's all complete. So I think it's very believable that first cargo will be in the next 2 months.
And these RFPs that you're pitching for at the moment, if you win those, how long do they typically last? I mean, one would assume that once this LNG pipeline starts flowing, it's pretty much non-stop, isn't it?
Yeah, these are programs. These are drilling completions, fracking and completions, and flowbacks, and getting these wells ready to be attached into the gathering system. So I mean, there's location. So it's kind of a bit of a traveling mobile system of going from one pad site to another. And these pad sites, have multiple wells on them. 4 to 14 wells per pad site. So you're on them for it's temporary, but some of them are several weeks to a few months. So. What's important, I think, is everybody understands the first phase of LNG Canada is almost 2 BCF of gas takeaway per day. I believe production in Canada is just forward of 18 BCF, so it's more than 10% of Canada's gas production going away in one project starting in the next month or two. Phase two, which there's talk on the street that completing phase two, which would double the takeaway, 1.84 BCF and then another 1.84 BCF. So you're talking, nearly 4 BCF once they complete the phase two. So this is a needle mover for the gas producers in Canada. It's a significant takeaway. And then, of course, there's three other smaller LNG projects that are at various stages of construction and approval. Two First Nations owned or led operations. Cedar LNG is partnered with Pembina Pipelines, a midstream operation, and the Kissimmee is another First Nations LNG project happening. And then, of course, Wood Fiber is happening closer to Vancouver in the Squamish area. They're already under construction. So, this participation that in the global LNG market that Canada is now starting to enter, like I said, is an absolute needle mover.
Yeah, right. And last year, Leonard, your co-founder and CEO, suggested that you had a huge addressable market, and at the moment, you're probably only serving 18% of it, I think was the number that he quoted. So, given that the market is huge, but you have increased the number of turbines you now have in your fleet, how close do you think you are to having the kind of capacity that you need? And if you need additional capacity, as I understand it, FlexEnergy only produces about 30 of these generators a year, and you're currently their largest customer, purchasing about a third of those, 10 of those. Do they have any scope to scale up production to meet your need?
Oh yeah. They've moved into over the last year, just short of a year. They've moved into a new facility in South Denver. They moved their manufacturing assembly facility from New Hampshire to Denver, and it's a lovely facility. It's got 5 available assembly lines. 2 are in play at the moment. They just started assembling. They had a couple of custom order units that were going to be placed on a offshore rig opportunity over in the Far East. So they were it's a kind of a special order, special design of the 333. It's a tremendous amount of stainless steel. It has to do obviously with the salt water and so forth. So once they get those cleared, they've got a fairly good plan for their domestic market, the new builds for their domestic market, as well as our order that we have with them as well, which will be right behind that. So we feel pretty comfortable with the size and scope of their ability to build the units. We were there in November, and like I said, it's a tremendous facility that they've put together there.
Okay, again, given the recent acquisition of their Canadian operation, does Enterprise have kind of priority, or are you kind of first in line in terms of having your needs met from their production?
Yeah, I mean, you can appreciate with the two management teams have grown a little bit of a very good relationship together. We are looking at quarterly. We'll keep addressing our needs going forward, so we can adjust each way. Any type of demand for those builds going forward. If we need to add or shift things, we'll be speaking fairly regularly. But we must understand that they have a pretty robust domestic market in the U.S. I mean, that's one of the reasons why there was a coming of minds on the acquisition of the Canadian operation. Many American companies, they look at the Canadian market as an 8 or 10% size of the U.S. market, so it doesn't always get the full consideration or the full effort in their minds of how to deal with that particular market. So they know our enthusiasm. We're well funded. They understand our business plan for Canada, which is far more robust than what they were able to give it attention to Canada. So it allows, in their eyes, ourselves at Enterprise to develop the Canadian market more fully and comprehensively, industry-wide, regionally as well. I mean, they just had the single location, which was in the hub of Grand Prairie, which is, again, servicing just the energy sector. Well, the Flex turbine has boundless opportunities. So it made sense selling the operations of the Canadian division to us, where we could advance at a much steeper rate than they could. They could concentrate on their domestic market, which is a large one, and of course they have some other global relationships as well in different parts of the world. So they could concentrate on that, and together, that would be a much better growth opportunity for Flex USA with this acquisition. Of course, inside of that arrangement, it's very collaborative, if we want to put it that way.
Yeah, no, that makes a lot of sense. Excuse me. I don't want to use the T word, but it's hard to avoid it. Given Trump and tariffs, is it likely that Canada reciprocates and imposes tariffs the other way around, which may cause these units to be more expensive for you going forward?
Well, first of all, the tariff talk and the way things are going. First of all of what we were the countries were fretting about 2.5 months ago seem to have completely subsided. There's arrangements and deals and negotiations being done to, basically remove some of the most dramatic scenarios that people were imagining. So I think there's a path to negotiation and more aligned trade and tariffs. Having said that, when in the last 2 and 3 months, when all this tariff talk was looking the worst case, Canada did come out with a reciprocal list of items for trade or tariffs coming into Canada, and we've been monitoring that list. That list was made, and then it was amended, or things were added to it, about a month and a half ago. There's no equipment, heavy equipment, any turbine, and I think it has to do with the construction and agriculture industries. There's no heavy duty equipment on that reciprocal list at all. So at the moment, these are USMCA compliant items. So, and they are exempt at the moment. Right. Don't appear to be on a reciprocal list for tariffs coming this way. So at the moment, the answer is it's likely not to be tariffed.
Okay, that's great news. Your gross margins are kind of approaching the 50% level, and you've got EBITDA margins of over 40%. As the business scales and you build bigger fleets and you benefit from economies of scale, do you see those margins expanding further, or are we now at kind of peak levels?
Well, it's profitable. Our divisions are profitable there, and all I can say is we're happy with these high 40s approaching 50% gross margins. EBIT does 40 and 40 plus. We're happy with those margins. We're interested in replicating those going out, and I think we can manage that. So our expectations internally are to keep those margins in those ranges. When you look at other energy services businesses that are reporting issuers that are equipment heavy, because that makes a difference. None of those companies are producing these kinds of margins. So,
no, these are fantastic margins. Most companies would die for these kind of numbers. So if you can maintain them, that's fantastic. And I don't think anybody could ask for more. Out of interest, you brought on a VP of Business Development in Calgary back in September last year to boost Evolution's market presence. I'm just wondering if demand is kind of exceeding supply. Why the push on sales and marketing? Are you preparing for expansion into new geographies and new industries? You mentioned earlier that you were speaking to people in mining already.
Yeah, well, first of all, I'll address the sort of future first. I mean, with our new acquisition of the FlexCanada operations, this now sets us up for the planning and the strategizing for industries outside of energy. That is going to require some more technical salespeople that we can set in a direction for the design and build, for mining, for commercial industrial applications, data center opportunities, stranded gas opportunities. So our business development team will undoubtedly get larger as we move through time. But having said that, when we brought him on, which is now going back a little over 6 months now, traditionally our sales and business development team were at the field level. Now, that works out quite well for the sort of legacy part of our business. But when we're dealing with the power systems that we're talking about, we're talking about there's more stakeholders involved. There's more decision makers on the logistics of making their own gas available, amongst other things. And of course, the application of the mobile power. There's drilling completions, there's midstream applications, there's production enhancement, and all of these are different division. I mean, if you think of some of the larger companies like the Canadian Natural Resources or Tourmalines or ConocoPhillips and Murphy and Shell and so forth, these are larger companies, and all of those stakeholders, some of those people don't even know each other. Right. So when we look at educating them on a new method, which this is, you need all those stakeholders to come to one place and properly receive and you need competent technical salespeople to present this type of a method because there's a tremendous amount of technical detail here. This is something the incumbent diesel units, on the bottom of every light tower, and that's that. There's nothing technical really about it. But when we talk about our bringing in a large unit designed for the entire needs of the site. It gets put onto site, and of course the arrangement and what needs to be powered by the microgrid and all the cabling and distribution panels and transfer switches and all of that is a different method, a different. And there's the safety around it, and one thing about our energy sector, safety is a big issue, and it's an industry inside of an industry. So when you educate a customer that this is a new method it does require a more concerted, and the sales process is a little longer. And as I said, some companies adopt this quicker than others. Sometimes you have to get through that sales process or that education process before you can actually get a decision made. And of course, if we can get to the end of that process with a larger company with all those stakeholders, it's usually a high percentage that they're going to go because of the safety aspects, the emissions aspects, and the cost aspects.
All right. And once you've won their trust, then they're going to keep coming back. Yeah. Okay. Makes a lot of sense. All right. Let's move on. In terms of kind of capital allocation and funding, some investors I know I've picked up through the different forums were critical of the recent equity raise due to dilution. You increased the share count from around 62,000 to 77,000, issuing 15,000 shares to raise just under $29 million, which is roughly a 20% dilution. But I see things very differently. You use that capital to effectively double your turbine fleet, which essentially doubles your earnings power once you can deploy it, and potentially more than doubles your bottom line thanks to operating leverage. So in effect, the way I'm looking at it is that I've given up 100% of X to now own 80% of 2X. Am I looking at that the right way?
Well, yes, you are. Obviously, to raise the funds on that equity raise, yes, share count goes up. You mentioned thousands, but those are millions. But
yes, sorry.
yes, it's front loaded. Share count goes up. On when we closed the deal on, I believe, December 12th. It went from 55 million to 60 to 77 or what have you. It is an instant increase. It starts every time you have an interim financial result goes out. Of course, it's impacted, and we haven't yet deployed the capital. So it's a bit front loaded and a bit distorted at the moment, but I do agree with your premise that you just described. It is taking a bit of a hit on dilution, but we have yet to deploy the capital. Obviously, in the last 2 weeks, we deployed 20 million of that capital with this acquisition. Now, the acquisition will need to show itself as being accretive over time. We believe that'll happen, quickly.
Yeah.
But no, your premise is correct, and I know there are many people in the capital markets. They have a hard time with increasing dilution, but usually what comes with increasing dilution is a capital raise, and it's up to the management team to properly deploy that capital, and as you said, get the leverage of obviously putting that capital to work. We feel the moves and the acquisition are going to be they're going to pay off tremendously. I mean, management is a 28% holder. We're shareholders of size ourselves. We'll continue to increase our positions personally, and we believe in what we're doing.
Excellent. At the moment, you've got room to take on more debt I assume. You've kind of restructured your funding facility. I think you locked in a new 41 million credit facility with Bank of Montreal, consolidated your debt, and cut your interest rate costs. And so I'm guessing you've got some headroom there. You're also anticipating strong cash flows in the months ahead, given the size of your expanded fleet and the LNG revolution going on in Canada. And the share price is arguably trading below intrinsic value. So on paper, a debt-funded buyback of those recently issued shares could be attractive. And you've also got a normal course issuer bid out, which would kind of support that. But you've mentioned previously that turbine deployments are highly accretive, paying for themselves in between 16 and 18 months, and yet generating returns for 20 years into the future. So given the accretive nature of reinvestment, are share buybacks a suboptimal use of capital right now? Should the priority be reinvesting every dollar into growth and extra turbines? I'm just wondering, how are you currently thinking about capital allocation priorities right now?
Well, you're correct to state that difference. We put in the NCIB. The stock was getting beaten up. I mean, there was a disappointment over the Q4, like we described earlier. The stock got beaten up, and it was inside of that malaise of all the trade talks. And I mean, the markets were, generally speaking, not specifically looking at the reaction of the Q4 result. It was right in the middle of the sky falling. All the
Yeah.
markets were coming off in a big way. So it just added to the downtick of the stock. So I mean, we just felt that we should be supporting the stock with the NCIB. I mean, it traded down in Canadian funds. I think it traded down to $1.18 or somewhere in that range.
Yeah.
Here's one of the unfortunate things is we initiated the NCIB, I think, late March, early April, and we were immediately caught in a blackout because of the upcoming news of we were getting close. We had the non-binding letter of intent in place, and we were negotiating what we knew was going to be the acquisition. So as management insiders, we were in a blackout, which also means the NCIB can't be active as well. And then, of course, once we got the acquisition announced, we were in the follow-up blackout because of our Q1 financials. So we've only been able to buy outside, or the NCIB put an order in to buy stock last Friday. So it's been unfortunate timing. So we missed out of actually supporting the stock in a meaningful way down in those lower prices. So, but getting back to your question, yes, the best dollar spent for enterprise is on our equipment offerings and the power units and all of the equipment offerings around that. You're right, subordinated. That it would be second prize to be bidding for stock at $1.70 when we can be buying equipment that pays out in the manner that it does. Having said that, if there was any pressure put onto the stock for price, we now have the means to be able to support. When and if
Right.
But you're right. It would be a second prize use of funds. Definitely growth and equipment offerings as demand grows is where we need to spend the dollars.
Yeah, makes sense. The FlexEnergy Canada acquisition came in at about 4.3 times trailing 3-year EBITDA, as I understand it, which gives you kind of an earnings yield of around 23%. But another way to view it, or at least the way I've been looking at this, is that you paid 20 million and picked up 17 turbines that retail for around 900,000 each. So that's about 15 million worth of assets, which would imply that the operating business only cost you around 5 million. So was this deal a real steal at closer to 1 times EBITDA?
Well, you're correct. A new unit coming off the assembly line is more like 900,000. Obviously, these are units that are a few years old. They have a 25-year life, so there's plenty of life. But they wouldn't be valued right at the new price. Having said that, we had our price for negotiation. It wasn't 20 million. The ownership group at Flex USA. There's a few owners. The majority owner is a private equity firm, and management is the remainder. So there was a lot of opinions on the other side, and they were above that. And it took some hard negotiating, but we felt that if you look at the history of our acquisitions over time, we've usually paid around 3 times EBITDA, and sometimes less. So this is reaching a little higher than our normal range of acquisition price. But this is a transformational acquisition for us. The opportunities and the blue sky available to us by acquiring the Canadian operations were well worth reaching up a little higher from the price we were first at. So we're happy with where everything sits. In the end, there'll be almost nothing associated with goodwill in this acquisition. So we feel it's the right price considering the negotiations we had.
Perfect. What else came with the FlexCanada deal? I mean, did it expand your geographic footprint beyond Alberta and British Columbia? Did you acquire new customers? Were any new industries unlocked for you?
The 17 units that are on long-term finance arrangement are in the energy sector. I would say 30% of those names we do business with already. The remainder will be new names for us. So there will be other opportunities to work with those clients in some of the other offerings that we do. Although the arrangement doesn't have any boundaries, it's all of Canada. Like I said earlier in the conversation, the FlexCanada operation was located in a energy heavy hub and was simply operating, servicing the energy sector. So there was no advanced opportunities in other adjacent industries from that operation. That will all have to come with our efforts in the near future and future. So it was a smaller cultivated business. Obviously, the Flex unit in the energy sector is very well known. It has a very valuable reputation. So that's the direction that the FlexCanada efforts have. We're purely servicing the energy sector. So we see the opportunities, multi-industry, commercial, industrial. Like I mentioned earlier, the stranded gas asset opportunities, the CHP, which is the combined heat and power opportunities for design and build. It's got a big future for us.
Right, but you didn't acquire any customers that you didn't have before.
Well, I did say that about 30% of their client list we know, we do business with. Remainder we. So there will be opportunities with those names to foster some more activity with.
Excellent. Okay.
A blend.
Yeah. Okay. Are you able to continue to operate under the FlexEnergy Canada brand name, or was that excluded from the acquisition?
Yeah, no, we together we mutually agreed that we would not use the Flex name.
Okay.
We'll be.
What about the FlexCare program? So as I understand it, the FlexCare program is an offering to service contracts for up to 20 years. But given that Enterprise historically has leased its generators, and I assume that service is bundled into the deal, does that additional revenue stream only apply to turbines previously sold by FlexCanada to third parties?
Well, yes. So in Canada, there's 50 plus, maybe 60-ish units that are embedded into the Canadian market that were purchased, and the majority of those units have FlexCare plans. So that's reoccurring revenue for now Enterprise. And we really, that's new to us. That's new type revenue, a reoccurring. We don't really have any reoccurring. So this comes with that, as well as the 17 turbines that we bought. Of course, there's long-term finance paper that came along with those. Obviously, as those expire, there'll be negotiations with the client if they renew, or if they don't renew, then we can redeploy those assets either long-term or into our short-term evolution business. And of course, the short-term business, fetches more revenue than the long-term, but they both have their value. But yeah, I hope that describes what you're looking for.
Yeah, no, it does. It does. We mentioned earlier about the Bank of Montreal new credit facility, and you said that the prior facility was paid out with a $1.5 million discount, which trimmed the Q1 2025 interest expense by over $127,000. I was just wondering, that interest expense being trimmed by $127,000, was that a one-off, or is that a recurring saving?
Well, I that was because we beat the in late February we were able to beat the pay it out, and of course, so you had a quarter where 1/3 of the finance costs were not there. That would be so. Having said that, now with the Bank of Montreal facility in play, if you look at our financials, we're basically going to have we're going to have the line at Bank of Montreal at about the same level as we had the Wagar private banking line. So right around that, 15 and a half, 15.8 million. So that basically, replenishes that cash that we utilized for. But debt levels, once we got rid of Wagar, paid the debt off, and once we bring Bank of Montreal back, that we'll have that same debt profile on the long-term debt. Going forward, what it does for us, I think you managed to mention that earlier. We were at a 10.5% interest rate with the Wagar facility. This is prime plus two-ish, so six and change, I believe it will be. So it'll be a tremendous savings on finance costs there. And of course, the private banking, there's other fees and other tag-on fees that come along with those arrangements, which get a far bit more simplified with the Bank of Montreal arrangement. And it's important to note that the negotiations with the Bank of Montreal, they are this line that we have with them is designed for growth. There's growth opportunities built into the line, so we're very pleased with the facility that we have with Bank of Montreal. It not only will be less cost of capital for us, but it's designed for growth and further acquisitions.
Okay, that makes a lot of sense. Okay, listen, you've been very generous with your time. I think I've asked pretty much all the questions I wanted to ask. Is there anything that perhaps I should have asked that I didn't?
We covered a lot of ground, James. Nothing comes to mind. I think we've talked about everything. Obviously the new line we're excited about, and yes, we did negotiate a $1.5 million discount. I don't mind repeating that because it's not often that you have a lender that was in a poorly positioned, and we utilized that to our benefit, and we were able to negotiate a payout that was far less than the balance. So it was a nice arrangement for us. Len Jarozik was very keen to get that negotiated, so we'll give Len credit for that discount on the buyout.
Very good. Okay, well, it's been a fascinating conversation. Thank you, Des. It's clear Enterprise is in the middle of something transformative. So thanks again for joining us, and best wishes for the business in the months and years ahead. As a shareholder myself, it's certainly an exciting time. Thanks again.
Cheers, James.
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.